Hello. As I was gathering information about Google and examining the financials in order to make the video, I was actually impressed to a point that I didn't expect. And to be fair, initially I wanted to make a video that would be more modest. But what I saw here actually made me change my mind and be more bullish actually. And I will explain why. Now, I always like to start with taking a look at the baseline of the company and examining the financial insights, the key financial insights, like the P ratio, the price to free cash flow, how the margins are doing and all that, the growth rates. So we will start by taking a look at this first. And as you would expect, P ratio of the company is heading upwards a little bit. And it's something to be expected because the price of the stock has been heading upwards. And if you go back a little bit, you will see that it has been trading upwards quite a lot in the past few months or so. And it's expected. Now, the outstanding shares, on the other hand, are going down. And this has various interpretations because we do know that Google is paying outstanding shares like stock-based compensation to employees, yet still their stock goes down. And before I examine the rest, I want to give you a cliffhanger here. If we take a look at the stock alerts, is a section that I absolutely love. We're going to examine these in detail a little bit later in the video, and you'll see exactly what is going on with the financials of Google like a true analyst, frankly. It's information that you are not going to find laid out so easily in front of you anywhere else, I'm pretty sure. And the tool actually compiles everything and generates them. It's so amazing. Now, you will see that the growth rates of the company have been tremendous. The revenues are going up, net income is up, and it's almost geometrical rise here. The total equity up as well, and the free cash flow is still up, even though the company is spending a ton, right, to fund data centers and all that, which is tremendous. They are doing really well here. Now, the margins are also still up, which were already really high. Like, look at this, like 32%, 60 almost, the gross profit margins, the operating margins. All of these are high and they are getting higher even. Slightly, but how much higher can you get, right? There's only as much as you can go for. And the returns are also pretty solid here. Now, in stock alerts, we are going to examine especially the return on invested capital in a little bit more detail. And we're also going to talk about the incremental invested capital, which is also extremely important. But the other stuff, virtually no debt here for the company. As you see, that's like no debt. Basically, the company is getting debt at will just to profit from the interest rates. It's like free money. That's all for the most part. And a little bit of dividend and all that. Now, I always also like to take a look at the income statement, the balance sheet, and the cash flow. Now, the widgets already give us the overview, but it's nice to see the overall story of the company. Now, these are quarters, and the tool actually has an insane amount of fields filled in, pretty much everything. It's tremendous what the AI is doing in grabbing the values. Remember, these are not from an external API because these tend to be really wrong, like I have tried them in the past. I have generated this with the help of very strong AI, and the results are really awesome. And this is why I'm able to create all sorts of these nice analysis for all companies now. And frankly, it's amazing. I'm thinking of the videos that I can make and salivating pretty much. So, 75 billion is what they used to have in 2015. Right now, the 12-month period, TTM, trailing 12-month period is what this is 385, almost 400 billion. Look at this growth. It's insane. And even now they're growing at 13%, 10%, even sitting at 350 billion. It's insane. And net income that is also going up proportionally, understandably so, as you would expect. And all these numbers here, the shares and all that. Now, the balance sheet, it's going to show us what is expected as well. The fact that their assets are, like the total assets are growing through the years, with the total liabilities again growing through the years in the same manner, proportionally. So things that you would expect. And basically highlighting a company that every year is doing better and better, which after so many years of operations is pretty insane. And you will be amazed by what is going to follow, because when we take a look at the stock alerts and all the other stuff that they have generated, you will see that the future is actually looking even more rosy. And that's the insane thing about it. That's what I love to see. And take a look at these capital expenditures. They started with 10 billion back in 2015, and now they're sitting at 8 times more. So this is why their free cash flow is a little bit, limited, but still positive, which is insane. like it's still very positive, even though they are spending tremendously. Like and the difference between last year and this year in regards of spend is also pretty high, while the free cash flow is still higher. That's like insane, right? So let's first take a look at the AI deep dive, because this one is actually reading the financial statements. Like this one is Q3 2025. Oops, sorry, this is automatic. Q3 2025, and gives you information about the whole quarter, scanned by AI and produced by AI. So the AI critically understands all the information here and lays out specific stories about the company, like quick takes, which are super important. And these quick takes also link to Q&A analysis. This is like 35 questions and answers that the AI prepared, and I can take a look at them however I want in order to understand specific parts of the company. So this is pretty fantastic also, like I use it all the time. And the way I do it is I take a look at this is how I start. So I see at a story and I'm like, okay, the monopoly bill is coming due. What does this mean? So these, if you click on it, you'll see it will take you to the story, the actual question and answer from the actual report, which is legal. Like it has to be legally binding and legally correct. They cannot lie in here. This is the actual report that the AI read. So how existential is the remedies decision issued in the US DOJ search case? Because they had like anti-monopolies rule pretty much, and they wanted, like the US Department of Justice sued Google over search practices. And so this may force like data sharing distribution changes that threaten their search economics. This is the whole story about it. And it's important, as you can understand. This gives you like some key metrics and important things to remember. And the bottom line, the remedies that force data sharing or change distribution could permanently reduce search monetization. Really important to bear in mind as you are examining the company, right? And there are more quick takes, like the paper gains are propping up profits, and we will talk about it in more detail. And other things like YouTube's 7.7 fixed bill, like licensing. This is YouTube pays content providers via fixed or minimum guaranteed commitments. And the bottom line, minimum content guarantee, 7.7 billion, create a recurring cost commitment, pretty much. Even though the amount of money that Google makes is probably too much to be worried about this one. Now, taking a look at the key stories here is a little bit different, because this, what it does, the quick takes is like general news here with like a magazine almost, but this actually dives deeper into the 4 more important things that happened in the quarter that deserve to be on their own here and deserve to be broken down into more specifics. So for instance, tons of cash, but they have actually spent it in their heads. Or if you take a look at the investors portion, even bigger commitments looming. It's more formal investor language pretty much for the analyst. So if you prefer this, and if you want to get more numbers, more specific details, the casual is actually a quicker way to quickly understand more easily what is going on. Now, you will see that between building new data centers, nearly 70 billion in projects that aren't finished yet, 42.6 billion in future and they're locked into, and a 32 billion deal to buy another company. So there is a lot of spend is what this is saying, and this is why it's neutral, because, you know, the spend also produces more economic output, right? The thing that we talked about earlier, the government might break their money-making business, and it is important. It's an important story, and it tells you the finer details here. I wouldn't worry too much about this one. These legal things tend to be mostly noise, but it's something that you need to know about absolutely if you're investing in the company, and especially in companies that this kind of this kind of potential breakdown could affect them a lot. I don't think that this is going to be a big deal for Google, frankly, eventually. Profits look great, but mostly lack on paper. Why does it say this one and why is this bearish? This is something that is not easy to understand if you actually read the report. You really need to know what is going on, and this is how the tool helps you like very quickly grasp what has actually happened, and not even needing to be an analyst on your own. Like this actually lays it down for you. Now, a huge part of the profit Alphabet reported this quarter didn't come from selling ads or cloud services. It came from paper gains on stocks they own. So they booked almost 11 billion in profit here, just because they think their investments are worth more now. Why does it say that? Why think their investments are worth more now? Well, Alphabet owns 61.1 in companies that aren't on the stock market yet. So what does this mean? These are private companies, and private companies are not like public companies in the way they expose data. so they don't really have to expose data to the public, and so their valuation is tougher, is more congested, more difficult, like everybody has their own opinion, and they don't have like an ISO, like a standard, so they tend to be blown up, is what this article is saying here. So you may be getting 10 billion, 10.7 is what Google thinks, but frankly somebody else could say 5 billion, and they could also have a point. You see what I mean? So, and you may be thinking to yourself, okay, dude, but aren't these comprehensive income? Why do I care? It's not part of net income, right? No, wrong. This has changed. This changed back in 2018. It used to be the case, and if you ask me, it used to be the correct case. It's not anymore, because right now you have to report this as part of your net income. This is important now because you need to potentially be paying closer attention to operating income instead of net revenue these days. You have to be careful, or both, frankly, but you have to be careful and analyze better. And this pretty much lays it on a plate for you, which is fairly nice. Something that's really hidden and you wouldn't be able to see otherwise. Now, let's take a look at some more details now by taking a look at the stock alerts. And I don't know if we have anything in the company profile that is worth examining here for Google. It's probably going to be the typical things, some things about the corporate history, like organization, probably not. So take a look at the stock alerts here. And by the way, Google is a company that even our free accounts can access. So you can see all these that I have been talking about. You can actually join the tool and take a look at this on your own. It's free. And by the way, if you want to do that, I have it here. It's on Stock AI Insights. So there are not two I's, it's only one, Stock AI Insights. And you can get a free trial pretty much. There's a ton of things to see. Very many things, like stories, smart money, smart insights. This is a feature that is probably going to talk about in a future video, is the AI help you answering questions for you. DCF valuations, we're going to do DCF for Google as well in this video. And the API, how complete it is and all that. It's in the Investors Academy, which I love, and we're going to talk a little bit about it with the stock alerts that I'm going to be doing next. Now, stock alerts. This section I have curated myself. All these metrics here I have curated personally, and I tried to make them in a way that are going to be easy to grasp, so that the information you get out of it is easily utilizable and usable. So this is not always easy to do, but I think I have achieved it, and hopefully with explaining some things and what they mean, I can help you like very quickly utilize them. Like for instance, margin trend here for the company. You can see that the margins are mentioned here from 2022 to 2024. You may be asking why not 2025, and the reason is the year is not complete yet. And for this reason, we cannot have an all-inclusive margin. It doesn't make sense because there is seasonality among companies. You have to account for the full year. As you'll see here, if I take a look at the quarterly, Google's latest report, I believe, is Q3 2025. Q3 2025. So we cannot really use 2025. We have to go by the end or the beginning of 2024. And if you're wondering what's the fiscal year for Google, you can actually find out here, or the API that I have, which tells you that the fiscal year is December 31. So basically FY 2024 is the end of 2024, the beginning of 2025. Now, let's go back to stock alerts. This is important. We are taking a look at how the margins are expanding for the company, the margin trend, and it's going upwards with a year-over-year change of 4.7 points on the percentage, that is, meaning that we have a strong trend of the operating margins are expanding. The company is doing well in terms of their core operations. Very important thing. Capital efficiency, I think that you will struggle to find somewhere or struggle to get a good explanation for it potentially. And the thing I have done with these metrics is I wanted you to be able to quickly understand what they are about. Like it's not, I don't want you to read like capital efficiency and be like, okay, what is this? This is why I have a learn more section here where you can actually read exactly what it is, but I can actually quickly tell you as well. The capital efficiency, basically, this one is the 3-year average return on invested capital, and this is the incremental invested capital. And I will explain it simply. Think about it like this. Let's say that you created a business initially, and you invested $100 to operate this business, right? And out of this $100, you are making $20 in profit, or actually you are making 34.8 in this case dollars in profit. That's fine, but as you grow your operations, the next $100 that you invest, the incremental investments of capital that you do, are normally producing, if you have good operations, are producing more on your money. Makes sense? It's economies of scale pretty much, sort of like a similar thing. So when you begin, things are tougher, but when you have already begun, things are getting easier through the years. And the incremental margins are similar here. By the way, these numbers are insane here. You will see like 42%, and the average that you will mostly see for companies, even for the caliber of Google, are going to be like 15%, 20%. This is an insane number. It's really high. And this also excludes the cash as it should for incremental invested capital. But if you include the cash, like 70%. But yeah, okay, so the incremental margins, it's a similar story. So I have an example here of a pizza that I thought a pizza shop pretty much that pays rent, bought ovens and hired staff. This happens at the first time. So making the first pizza costs more, costs all of these, right? But making the 100th pizza is cheaper now, economies of scale, right? It's easier to produce the 100th car than the first car, right? So this is the point here. And so the incremental margins are telling you this. And I'll tell you for every $100 in new sales, so this is key, for $40 pretty much become profit with a current operating margin pretty strong as well. So hopefully this all makes sense. Now the earnings quality here and the free cash flow quality are going to tell us how efficient the company is, how much of a quality the profits that it produces have. So cash flows exceed reported earnings here by 35.1%. And again, if you take a look at how this can happen, because you can have you may be thinking to yourself, how can this be more actually? And the reason for this is what I talked about earlier, for instance, like paper investment gains, which is a big thing for Google here because they made like $10 billion in paper investment gains, or customers lagging payments, right? So you haven't collected the cash, but it's part of the revenue. So this is important, this accounting pretty much. So this is how you do it, or inventory buildup. This indicates that the company is very healthy here in terms of earnings quality, which is fantastic to see for Google as well. So it's a 5 out of 5. Now, the free cash flow quality is pretty much about the same thing, but about cash flow, so free cash flow. So it actually accounts for the capital expenditures. But it tells you the same story pretty much. So the strong FCF generator, converting almost 86% of earnings to free cash flow. So the company efficiently translates profits into cash, which is important. Owner earnings. Now this is a little bit more complex, and again I have the formula here. This is a thing that Buffett liked to use. In a 1986 letter, explained that accounting earnings don't tell the whole story, and so pretty much what Buffett wants to do here is exclude things like working capital and gain a more clear picture of the company here. And I have adjusted it a little bit because things have obviously changed from 1986 where he did that. And the new version makes more sense because it excludes the stock-based compensation, which is a big deal. And I actually have added a warning here when it happens. And I'm saying high SBC, stock-based compensation is 23% of net income, very high here. So this dilutes existing shareholders, as you can understand. And the company is effectively paying employees with your ownership stake. Now, this may sound bad, but when you actually take a look at the overall metrics and what we are going to see in the next alerts, you will see that it's not that bad because it's actually effectively balanced with other things about the company, especially the profit pretty much. And so, yeah, heavy investment but growing. This is the point. And you can see it here because, yeah, these metrics are very complex. Like they have a lot of scenarios. Like you will see here a rating boosted. You see the green letters. Revenue grew 14%. So why does it tell you that? It tells you this because it's important to see that revenue has boosted while this is going down. So you see it's less than 50% because there are heavy capital requirements here. So it's a different case. The company appears strategic in terms of heavy investments. It's not the fact that they are doing it for, you get a low metric just because it's low, actually. It's the fact that they are actually spending money on reinvesting that this happens for. Very, very important. And this tells you the numbers here exactly. It's really cool. Now, goodwill risk. Goodwill is a sort of like a convoluted term, which basically, if you cut it down to what it simply means, in my country, I'm Greek, we call it air, how much air I paid for a company. Meaning, you have a company that its assets are cost like 10 billion, but if it's like Coca-Cola, nobody's going to give you the company just for its assets, right? Or the cash that it has. You're buying the name also. So for goodwill risk, this is what we're seeing here. How much they have spent on buying other companies at a premium. So if they paid the 100 million for a company with 600 in actual assets, the extra 40 million becomes the goodwill or the air that I mentioned earlier. So low goodwill risk here is not what Google is doing, which is nice to see, because some companies buy companies and write down assets and stuff they are not doing well. So this is what it tells you. Inventory bloat is something that you wouldn't expect from Google, because what kind of inventory? They have just some phones and stuff. It's mostly a services software company. And this is why their inventory compared to the revenue is like 1%, not even 1%. And this is green, but frankly speaking, is kind of irrelevant. Still, it's good to know that they, what they are doing here in terms of the revenue of their inventory bloat. They have extra inventory. If you're looking at companies like Walmart in our tool, this is going to be a completely different story. Asset maintenance is how much capital expenditures they are spending on depreciating assets, because assets depreciate, like factories, stores, equipment, they wear out over time, as you see, right? So are they spending enough to replacement, or are they letting things fall apart? And you see here they are overdoing it even. So 3.4 with a 3-year average of 2.9 in terms of their history. Strong investment, capex at 343% of depreciation, well above replacement needs, obviously, indicating that the company is expanding. We know about this, but you can see it in numbers as well. Now, going back to what we talked a little bit about earlier, share dilution, stock-based compensation. Now, share dilution, you will see that the company is actually buying back shares, even though they have quite a lot of stock-based compensation. It's not that high compared to SBC as a percentage of revenue, but it's a high number. So rating boosted because the revenue grew 14% is what I'm doing here. Again, I have curated this personally because in some situations, we are going to see a company having an alert here that could be low, but when you compare it to what they are actually doing economically, it makes sense. And so it may be a green situation because of the overall situation of the company, like the overall revenue boost, for instance. So if you for instance, spend money on capital expenditures and increase your revenue, increase your top and bottom lines even, then it makes a ton of sense to actually be spending that. So it's a green situation, it's not really a red situation. You see what I mean? So it's going to be a little bit more complex, actually much more complex. And I'm trying to account for all this. Again, each of these is very, very complex, has a lot of different scenarios. Now, the share buyback quality here, as you'll see, companies often announce buybacks as a way to reward shareholders, is what we know. So a good buyback program shrinks the pie, so your slice gets bigger. Now, I wanted to have this because when you are actually issuing shares and buying back shares, this actually has to do with your stock-based compensation as well. Like, think about it this way. Let's say that your company is buying back $5 billion of shares. So they are actually buying back shares. And you are like, okay, this is amazing. Now I own more shares. They are getting shares back. So they are getting them rid from the market pretty much. However, some companies may be doing that in order to get these shares to give them back to their employees for their stock-based compensation, effectively cancelling out this whole operation. So you can see that can be a little bit of a marketing thing, but eventually, practically speaking, it's the same for you. This metric tells you whether that's the case. So what happened here in terms of the buybacks to operating cash flow? And also what happened here in terms of the 3-year change of the shares? So are you seeing a situation where the company is buying back shares, but you're not getting the benefit, like you are not getting less shares in the market, right? You understand this, right? So it's like, are the number of shares actually reduced, or they are actually giving them back to employees, is what this is saying. So very, very important here. And you will see your ownership is still growing, is what this is saying. Why? Because now it's almost 8% less shares. Fantastic. Now, receivables quality and accruals quality is a thing that is probably not that important for Google. It's much more important for companies that have a lot of like vendors and suppliers and all that. However, their average collection time here is 15% of annual revenue, or 1.8 months of sales sitting uncollected, which is nothing pretty much. So they're getting paid pretty much immediately here. And a company says it made $100 in profit, but how much actually showed up in cash, the accruals? This is for every $100 for Google. 125 showed up, and you may be wondering, how is this more? Like, how can you earn 100 and get 125 in cash? But remember, we have things like depreciation, we have things like SBC that don't use cash, and they have to be added back. So this is why you're getting higher values, and obviously this is good. Now, this is 1.1 out of 5, and you may be wondering, dude, everything was looking so fine. Why is this 1.5, 1 out of 5? Take a look at this one. I have a learn more here as well. So Michael Berry, everybody knows him, is known for being bearish and sometimes overstates risks. But remember, at some point in 2024, if you were following the news, he said, flagged that companies like Meta and Microsoft are depreciating AI data centers equipment over 5 to 6 years when the chips actually become obsolete in 2 to 3 years due to rapid AI advancement. What is he saying here? What is he thinking? So what Berry is saying is that companies create longer depreciation schedules for things like servers, for instance, and you see if they deprecate them over 10 years, that's 10 million per year expense. And think about it in a scale of hundreds of thousands of servers, obviously, right? But if those servers are really obsolete in 4 years, because technology moves fast, the expense should be 25 million a year. So as you can understand, this difference is actual profit that you see in accounting. This is why what he's stating here, that there is sort of like some books cooking pretty much going on. And he's not that wrong about this one, and this is why this is 1 out of 5, frankly. So red flag, the company assumes 11.2 years asset lives versus the benchmark that you see here, which is 5 years in tech. For each industry, I have specific benchmarks here because, as you can understand, for tech it may be 5 years, but for tractors it could be 20 years. It's a completely different business, right? And the depreciation is completely different. So each company, each industry, pretty much, and each company, of course, because of that, gets a different benchmark. So it's not going to be 5 years for everybody, of course, because it doesn't make sense. But for this one, 5 it does make sense, if not even lower in this kind of environment. And so this is why you're looking at a red here, because they have a long schedule, which it's something that you need to flag when you are analyzing the company. Debt coverage, it's a company that doesn't have debt, frankly speaking. The payoff time here is 1.2 months. If you are taking a look at the EBITDA, debt to EBITDA, and some of you may be thinking, why are we looking at EBITDA? Why not like net income, for instance? And there is a reason for this, and the reason is cyclical. And I have it here. It would be cyclical. Because why? Because if you take a look at EBITDA, what is it? Earnings before income taxes, depreciation, amortization, right? So, do I see it? I think I have added it here just to mention it. Yeah, I have it here. Why not net income? Net income already subtracted interest expense. If you are asking, can they pay interest, you can't use a number that already assumes they paid it, right? So it's circular. And this is why it makes more sense for the most part to be utilizing EBITDA for this kind of metric here. Now, companies may not report it, and in some situations may be a little bit sketchy, because EBITDA is not a GAAP metric, they don't have to report it. But if we have it, it's really nice to calculate it like this as well. But for the case of Google, they are fantastic. Altman Z-score and Binary score, I'm not going to expand too much, because these are formulas that are pretty messy to deal with, but you can read about them and see the finer details. Simply speaking, you can think of this as the risk of bankruptcy and the risk of books cooking. Like, for instance, the Enron situation would have been a big red here, a really big red. So these are fantastic for Google pretty much. Obviously, no risk of bankruptcy. I think the safe zone is like 2 or something. Yeah, 2.9. And 2.99 pretty much is the safest. And over here, you will see the Bainey score as well, which is an M score here, which suggests that manipulation is unlikely. And this is what we had for stock alerts. And as you'll see, the numbers are so amazing that I ended up even changing the title of the video, frankly, and I think it's actually fair what I did. I think it makes sense. I didn't just do it for the video. Now, the last thing we're going to do is what we used to do in the past, if you were following this channel, in my previous tool with the stock evaluator, which was much more primitive than this one, which is way more advanced. Now, this one is even going to tell you if the company is spending a lot in free cash flow. So are they a capital intense company or not? What is this? Measures how much a company must reinvest in physical assets to maintain and grow in its business. Why it matters, for instance, because they have less free cash flow available to shareholders, as you can understand. This is the case for Google, and the tool actually tells you this. So moderate capital intensity, expect to see free cash flows that are lower because of a lot of the cash flow is going towards capital expenditures. Is the thing. So this is telling you that FCF is suppressed because of this. So bear this in mind when you are taking the evaluation. And it also accounts for the model of the company and the analysis period. Things change a little bit based on that. It tells you the historical averages which we want to use, but what I have done here is I have made different investment scenarios for DCF. DCF can be used in all sorts of different ways, and especially the required return here, which I like to use 13%. You will find that other people or other metrics, other websites potentially could be using 8 or 9%, and you may not even be understanding why they do that. You may have heard of the WACC, for instance, the weighted average cost of capital, and you may be thinking, why are they using 9? Why am I using 13? Why is somebody else using 11? Let me explain this, and I will explain it with the help of the Investors Academy, which you can study on your own. And let's take a look at WACC. So I'm going to try to help you understand it in a practical manner easily. And let me find it here. So the WACC versus required return. The analyst DCF usually has something like a 9 to 10%. Our required returns have usually something that's higher than 10%. Why, you're asking? So an analyst has a different, is actually analyzing something for a different purpose. So they are trying to find out what the market should price the company at. But you, as an investor, you don't really care about that. You care about how much money you're making out of the company. So it's a different situation. You need more returns, is what this is saying. Because the weighted average cost of capital is two portions. Is the debt and it's the cost of capital. The cost of capital that comes from equity, like for instance when you're buying stock from a company. When you're buying stock from a company as a stockholder, you expect something that is more than 10%. The amount of this has to do with premiums and all that about the economy is a little bit of a formula. But the point is that when you are actually getting the weighted cost of capital, you see how much debt the company is funding operations from and how much from capital of shareholders. And the debt has like an interest rate of like 5%. The shareholders require a return of like 12%. So this gets a weighted average and it goes down because the debt requires less. And this is where you value it for instance, if you want to acquire a company, what's the market value? I hope this makes sense and it makes things a little bit more clear. But for a personal DCF, as an investor, for your sake, this changes. Because now, when you're buying a stock, you're not buying the business itself. You're buying the business to make money out of it. And so, if you can make 10% out of an index fund, why would you buy Google, right? So this is why we typically ask for something like 12% or 13%. And this is why you're looking at different situations from DCF, because DCF is obviously can really change depending on what kind of input you provide it with. Really important, that is. So you can try both, obviously, with the two, of course. But what I have done is I have created different scenarios for different investment appetites. And I even have a meme scenario here, the Cathy Wood innovation, which takes it to very, very high values deliberately. This is almost like a joke, frankly. But okay, I wanted to add it this. Now, this gives you pre-populated values. So this changes based on the scenario here, as you'll say. This actually changes the metrics, the assumptions, I should say, for the DCF. But, and it has the reasoning for each one. The stock A insights, pretty much, Lucky 13 is what I like to use, a 13% required return. But notice, before I run this, whenever we have a 13%, especially on a market that is going high, we're gonna get much lower expected values here. This is something to be expected. And it's deliberate. Now, that doesn't necessarily, of course, mean that we're not buying the company, right? Because we're not only buying the company for the cash flows it produces, there are many more things at play. And I have talked about them in the past in other videos. There's a ton of things that you are evaluating when you're buying the company. It's not like you are getting interest payment out of it. It's not a bond. But it gives you a nice baseline, and I always like to examine it, see how far we are from the actual free cash flows generation. And remember, this company is also spending a ton of free cash flow on capital expenditures, making this even lower than what you would think. So even though you see here something like 132, this doesn't mean that the company is worth that, even for the highest valuations. And if I take it to 9%, which is close to what you will see for a WACC calculation, maybe 8 to 9, it's usually what it is because the interests are like 5% for the most part, you will see that this is going to be higher now because we have lesser expected required return, but still we are off from the actual value. But again, the tool already tells you that the moderate capital intensity is something that you would expect out of this situation. So you can see how you can get a full picture of what the company is doing and fully evaluate. For me, this company is a buy even now. Obviously, I would actually love to get it at a cheaper price. So if it gets a little bit of a discount at some point, it hasn't been happening for a while now. Everything is ripping. But even at this valuation, I think the company will multiple itself multiple times. Will actually increase itself the price multiple times through the years, because what I'm seeing here and what we have examined together paints a really fascinating story for the company, doesn't it? I'd like to hear what your opinion is about this. And thank you for watching. If you enjoyed this video, if you learned something, please leave a like. That helps me a ton. Really, really helps me, and it takes you like 1 second. So thanks for watching again, and I'll see you in the next video, guys. Bye-bye.